So why don't we shift gears and talk about your CIO process? How does it work? And what happens when there's not consensus? He's got a partner who says, look, I'm excited about this deal. I want to do this deal. And someone else on the table doesn't agree. And how does that vary? You're the CIO, so you're going to have the biggest thumb in the room. But do you require consensus in the group?
So first, as the CII, I don't have the biggest thumb in the room. I am one person in a process that we've outlined that we think works for us. Now, I'm going to be a little bit an overgeneralization here, make an overgeneralization. And in fact, I don't mean to offend anyone with this generalization. But if you actually think about the venture industry, there are two main types of models that I think a venture firm can adhere to. One, I affectionately call the genius model. And the genius model basically says you hire someone who is ridiculously insightful, borderline genius level, and you figure out how to round up a bunch of deal flow, top of funnel every single year. And what they do is they just meet with founders and look at the businesses and then they point and they say, this is the one. And you ask why,
Mhm.
and they say, because I'm a genius. I've seen lots of things. This is the one. This is the one that has the right return profile, risk profile. Like it just is the one. This is the founder with special sauce and a model that's going to succeed. And you basically assemble a bunch of geniuses together within the firm, and they each have their funnel and they figure out what they like to do. And by and large, they stay out of each other's way because they create swim lanes for the things that they want to look at. And they say, no, I'm the genius for thing X and you're the genius for thing Y. You go do your thing. We'll go do our thing. And then we'll come together when we need to raise, right? So it's a shared capital base, but independent. Uh,
Each partner has their own swim lane or show. Yeah.
that's right. And by the way, this can work and it can work incredibly well if you hire the right people. But
Mm,
ability to scale is contingent on you finding geniuses that can continue to deliver, right?
mm,
And by the way, a lot of people think venture isn't scalable because they ascribe to this model. And they say you can only figure out how to put so many people together in a model like that and have it work. The other model, you could treat investing as a profession. And you can say, look, you still need ridiculously talented people. This is not a job where an average, person can really do it well. But you need very talented people, but it's skill and it's something that can be fine tuned. And to fine tune it, you need a process that's repeatable. You need a feedback loop. You need repeatability in a lot of ways. And for
mm.
us, we've tried to design a process and hire the right people where we think the process itself creates the outputs that you need in order to manufacture returns. And there are a lot of similarities between the two models because it all starts with really talented people and generating deal flow and evaluating it. And eventually you point and say, this is like a business that I'm really excited about. But for us, no individual investor underwrites alone. When they get interested in something, a small team forms. And that team is meant to protect against proximity bias, as well as make sure that all corners of the investment opportunity are examined. Because one of the most difficult things to do as an investor, and you need to have this skill to be a talented investor. And it's why a lot of operators, by the way, cannot make the transition to becoming a good investor, is that you have to hold two things true at the same time. One, that there's tons of risks in the business and the chances are it isn't going to work. And identifying those risks typically is pretty easy. Figuring out in advance why something will fail, super simple for intelligent people. You can point out why something will not work. And in fact, you can come up with a dozen reasons why a startup will.
Mhm.
But simultaneously, you have to hold true that if everything goes right, how big of a business could you build? Because you only get paid if you say yes and make an investment and the risks don't materialize and a big business is built on the other side.
Mhm.
So by having multiple people in the process, it's about challenging and saying, look, here are the risks. We know what the risks are. Are these risks that we're willing to take on because we believe the upside offsets it? So you have
Uh-huh.
a good return trade off for the risks you're taking on.
Mhm,
Now,
mhm.
if every deal were priced at 3 million pre or 5 million pre, and with one check, you could figure out if a company were on a trajectory to a mega multi-billion dollar IPO, then you don't have to worry about the risks. All you have to do is worry about the upside, right? But when you're de-risking a business in stages, you need a process which really outlines what you're going to learn, how quickly you're going to learn it, how much money it's going to cost you to learn it, and then what happens next if they de-risk a business that
Right.
looks good. So you're really playing a multi-turn game. It's not a single turn game. And a good underwrite says, this is what we're going to de-risk with this capital, which leads us to this position in the company. And then we're going to do these things next. And it's going to require this much capital to learn this about the business. And even though you're wrong in advance, the logic of going through this paints a picture of what it would take to build a very successful business in that space. It gives you an idea of how much capital it might need. It gives you an idea of how quickly you can learn and how efficient you are for every dollar you put into a company
Right.
to learn. And it gives you a narrative to talk to the founder about, right? So a lot of VCs don't like underwriting the business plan. And in our underwrite, we underwrite the financial forecast and business plan pretty deep because the financial plan is an articulation of how the founder sees the future playing out, just expressed in numbers. And there's so many interesting embedded assumptions in there that you can use to talk to the founder about why they think their business is going to unfold the way that they think it's going to unfold. And it's that conversation with a small team of people and the founder that exposes how the founder thinks, why they believe the things they believe. It gives us a chance to maybe insert some new information and maybe tweak the plan, right? Maybe make it better, maybe make it more capital efficient, maybe knock down the number of things they're working on and give them a better chance of focusing on the things that need to be de-risked. But it's that entire underwriting process with a small team that comes together that ultimately helps prosecute both the risks plus understanding the upside of the business if things go right.
Mhm. Right. I like the discovery hypothesis based approach to where you've got different milestones. You're saying, okay, look, here's the current traction today. What's the incremental spend or investment capital we're going to make to learn something new? And I think you have a poker analogy around that, which I love too. I think decision making uncertainty is a very good framework to think about investing in startups. If you're dealt pocket spades, you're going to invest to understand the flop. Whereas if you've got a mixed pair, you might calibrate differently in terms of your investment appetite or valuation.
Yeah. The question that I constantly challenge the team about to get an answer to is how much can you learn for how much money, how quickly? Right.
Right.
That's
Exactly.
all you really care about because this financial model that's produced by the founder describes a
Exactly.
magical business on the other side,
Right.
right? There's no reason
Right.
for them to put it together if there isn't an outcome that looks just amazing.
Of course. They all look great. It's always up and to the right. Never seen one that
And everything looks
always
great, high margins, you've got a big market to attack, you build this
right.
giant business, it's a profit machine, right? So you've got this magical spreadsheet. And then as you dig in, you say, wait a minute, how much is it going to cost me to learn whether we're right or wrong about this critical driver of the business? And
Right.
understanding whether you're going to de-risk it with this money that would come into this round or money in the next round is really important. So a lot of the work that we do with founders during our underwrite is to create discipline around the learning agenda.
Absolutely. That's exactly the right approach to take. You're going into the dark forest. You have an intuition, there's light on the other side, there's a prize, there's a pot of gold. You're dealing with uncertainty and you've got to prioritize and do fewer experiments more quickly, cost efficiently.